I've been reading about excess of loss reinsurance per event, but I'm still unsure how it works. Could you explain it with examples?
Sure, it's a type of non-proportional reinsurance where the reinsurer covers losses that exceed a set amount from a single event. The insurer pays up to a certain limit, called the retention, and the reinsurer covers anything above that, up to a limit.
So, it's meant to protect insurers when a large event causes losses beyond what they can handle?
Exactly. For example, let's say an insurer has a $5 million retention on property policies. If a fire causes $12 million in damages, the insurer pays the first $5 million and the reinsurer covers the remaining $7 million.
I see. So the reinsurer steps in only after the losses from a single event exceed the retention?
Yes, that's what makes it different from proportional reinsurance. The insurer only gets reinsurance support when losses exceed the agreed threshold.
Could you give an example in another line of business?
Sure. In marine insurance, if an insurer has a $3 million retention and a ship accident causes $8 million in losses, the reinsurer would cover the $5 million excess after the insurer pays the retention.
So, this protects insurers from unusually large losses from one event?
Exactly. It's useful for high-value assets like ships or commercial properties where a single event could cause significant losses. It limits the insurer's exposure while keeping premiums stable.
How does the reinsurer decide how much to cover after the retention?
Reinsurers set a limit. For instance, if the reinsurer covers up to $10 million, any loss beyond that would still be the insurer's responsibility.
Is this different from catastrophe excessive loss?
Yes. Excessive loss per event covers single losses, like a fire. Catastrophe excessive loss covers multiple claims from one catastrophic event, like a hurricane affecting many properties.
So, excess of loss per event is more focused on large, isolated losses?
Exactly. It's used for industries with high-value assets, like aviation, property, or marine, where one major incident can cause significant financial exposure.
How does the reinsurer assess whether to offer this type of reinsurance?
They review the insurer's risk profile, claims history, and the frequency of large claims. The reinsurer needs to ensure that the retention and coverage limits match the risk level.
So, reinsurers carefully evaluate the insurer's risk before agreeing?
Exactly. The reinsurer has to balance protection and risk management, ensuring both parties are covered appropriately.
I understand. Excess of loss reinsurance per event helps insurers cover unexpected large claims without taking on too much risk.